Hey, welcome back to Tuesday Guys Trade Stocks. I'm Dylan.
And I'm Vinny, and today we're going to do a little bit of a unconventional deep dive into a stock that I don't typically follow as a viewer request. So bear with us. We're going to use a different kind of methodology in terms of evaluating this company, and we'll get into the nitty gritty of whether or not I plan on buying any at the end of the video. All right,
It
with
does
that,
look
we'll get to
enticing.
it.
Ooh, wrong one.
Interesting. Yeah. I mean, I always, explore something new, learn something new. Hey, this was very, very kind. A user made a super chat to the channel and specifically requested this video. And I was like, I kind of got to do it at that point. I felt like, I wouldn't disappoint my friend Andy here. So thank you for that. But it's not a company I follow. So this is my first time looking into it. And, I kind of did a little bit of research online to see what other people were talking about it. And the thing that kept coming up that was interesting was referring to it as like a cigar butt. If you've heard that investing term before,
Uh-uh.
no. Yeah, it's old school. It actually comes from this guy, Benjamin Graham, considered the father of value investing. And the idea being that a cigar butt, as in like a discarded butt of a cigar, you could pick it up, light it up, and get a couple of puffs out of it because there was still a little bit left. That's kind of the style of investing that he was on the forefront of. And he's got a couple of disciples that are a little bit better known. This guy over here, I don't know, Warren Buffett, maybe, and then Michael Burry, someone who's very, very much like in the vein of some of the people we talk about in this channel here in particular. A little more modern takes on value investing, but the cigar butt mentality is where they got their roots from. So we're going to talk about it from this Benjamin Graham style analysis. But if you want to look at the charts compared to other retailers, we'll take a peek at that first.
You got it. Okay, so here's the chart. Sorry, this is Dillard's. That was misleading. So basically, the comment was he invested in it during COVID, and there was a big run up. So this was KSS. All right, so I'm assuming he got in around here and then enjoyed this nice $19 to oof, 63. Good job, man.
Yeah.
That's sexy, right? That's awesome. Whether that was deserved for the company is what we're trying to look at. So
Mhm.
here's just some competitors, okay? So JW, so Nordstrom, same chart, right? So we're trying
Mhm.
to see, was this Kohl specific or was this industry related, right? Because also during this time, which I'm not going to show, is about 20 electric car companies that are dead and also had the same chart, right?
Yeah.
They like Lordstown, they're the Lucid, there's a crap ton of them, but they
And
all shot up and then just slowly leaked and died.
yeah. And this
Um,
is stimulus check time too. So
this is stimulus check time.
yeah.
Target, massive run up, did not have the big dip, but during the same time frame, Target's actually almost the antithesis of KSS, right? Of Kohls. I have a tough time if I were to invest in this area if I would do Target or Kohls, which we'll talk about. And then this is Dillard's. So same thing. They all had a run up, and then just so you can see the SPY, here's the dip, and then a run up during that period.
Yeah.
So
Exactly.
SPY 338 to 477.
Okay. So if you want to go back to the presentation here,
Yep.
the nice thing about Benjamin Graham is he left behind like basically a checklist of things that he looks for when he buys a stock. It's a 10-point checklist. So we're going to do each of those individually for KSS, and I'll give you some other thoughts about the valuation of KSS here at the end. Okay, mind you, like I said, this is just Benjamin Graham's methodology. This is looking at it from that cigar butt kind of mentality. So first one up here is the earnings yield. All right, to price twice that of the triple bond rate. All right. This is something I've talked about with other stocks. If I can get double what the bond rate is on a company, that's pretty compelling. Bond rate, according to Moody's right now, is 5.2%. As far as the trailing 12 month EPS for KSS, I came in at $2.20. And then stock price today, as of filming, is $13.21. So that's a 16.6% bond yield. So that's, or yield, sorry, not bond yield. That's double the bond yield. All right. That's, no one needed a math scholar to do that math there. So yes, on that point, it makes that metric. All right, mind you, that's backwards looking in terms of EPS, not forwards
Hmm.
looking. So I tend to want to look a lot forward. But all right, now PE ratio, is it less than 40% of the highest it's had over 5 years? This is actually something that Burry uses in the past too to find those fallen angels a little bit. All right. So where did the PE for KSS kind of peak? All right. Yeah, we have this COVID peak. I'm not going to count that. Just this one blip here. Obviously, there's a lot of distortion. To me, like I can't use that, right? But it's pretty obvious that their baseline is right around 10, Right? They hug that line for a long, long time.
Long time.
That seems to be where the business wants to trade. That's where retail often trades, and they're at 5.96 today. All right, so they're around 60% of their peak. So, discount, but not to the degree that a Benjamin Graham cigar
A
butt style
cigar
investment.
butt, not a cigar
Yeah,
butt. Technically, GameStop would have been a cigar butt
yes, it would have been. Yes, it
before
would have
that
been.
whole
And
thing.
that's why
Yeah.
Burry, like I said, he does use this kind of methodology. This is like the core of it. I mean, obviously, he's evolved it a lot since then. So it doesn't meet this metric. All right. Number three, dividend yield at least 2/3 of the AAA bond yield. Right. Uh, you know, Dividends are a lot more important in Benjamin Graham's day than they are today. So, but it's still something we can use to evaluate. Particularly, actually, their dividend yield looks pretty large. Um, we'll talk about the safety of that at the end of the video. Uh, According to Google, it's actually calculated at 15% dividend yield right now. They're paying 50 cents a quarter on a $13 stock.
Yeah. That's too high. Yeah. So that's terrifying. I get you're like, ooh, that's 15%. But when you have a company who just changed their CEO, just happened, and then also are going to close like 27 stores this month, that's a terror that kills your cash flow. That I don't like that.
It,
Your cash flow is at risk.
yeah, it's a scary thing. Like I said, I want to go into more detail on that one a little bit at the end, but it definitely it's so high that it certainly is going to meet this metric, but it's a little bit worryingly high to me. All right, but it does get that point. Right? All right, stock price below 2/3 of the tangible book value per share. And this is back in the day when the book value and what you're really buying mattered, right? So we look at the book value here. I forget what website I got this table from. It was just easier to use their data. But $3.9 billion basically, right? So 66% of that would be 2.57 billion, and then this is from CNBC. The market cap today is 1.47 billion. Right, so that is less than 66% of it. So it does get that point. All right. Stock price below 2/3 of the net current asset value. Right. That's another metric that he used. So the net current asset value, according to this is like I think FinTel, is actually negative
Oh.
for KSS. Now, you know, so one of the real gripes here is that we now capitalize leases. They didn't do that in Benjamin Graham's day. So if you were to back out the leases, what would this value be? That's something you could calculate if this is like your style of investing. The Whether or not it's the right thing to do, capitalizing leases, well, it's for each himself to kind of decide. From a standpoint of how risky their lease situation is, my understanding is KSS is actually pretty safe compared to other enterprises within their industry in terms of their leasing, but doesn't get that one negative number. Although below is not the kind of below we're looking for here. Okay,
Right.
Total debt less than book value. All right, so there's another kind of debt related metric here. So this is actually I used Google AI in order to give me this one here. But the book value ratio is 2.05 according to them. All right.
Okay.
Total debt 7.3, and then the shareholder book value is 3.89, which is actually interesting. It kind of agrees with that other page. So it's nice that the Google AI is indeed giving me accurate data compared to other sources. It's something you can go calculate yourself though if you want to. But it is not less than, right. It is double, right. But once again,
Not
like I
ideal.
said, yeah, that includes capitalized leases. This is
It
something
does.
they didn't do in Benjamin Graham's day. All right, so take that as you
I
will.
would throw that point out because it's a big deal. That's a
Yeah,
big change.
you certainly can. You certainly can. I completely get the argument for it. It's not something I have a particularly strong opinion about. It is currently gap principles. This is something like Buffett will talk about. Like we follow a gap whether or not we agree with it, but that is the current standard. Right?
Fair.
So current ratio is kind of seen as like a bankruptcy risk. How likely is this business
Right.
to go out of business, right?
For
So they
instance,
want it greater than
Walgreens.
2, being a well capitalized business, right? So as far as their current ratio right now, this is according to Macro Trends, 1.05. So, I mean, not fantastic. It has been higher. It's been closer to that 2 ratio in the past. They've been in a downward trend since the pandemic, basically here as far as their current ratio. They did use a fair amount of cash to buy back shares. Unfortunately, when it was like $60 a share, not when it was 13. But
Is
hindsight,
that when they did it?
yeah, they were. They
Ugh.
have done some at lower prices, but they were also buying back shares when it was $60 a share.
That's
Instead of paying
not
down debt.
good allocation of capital.
Well, new management, so can't entirely blame them for the sins of the past, right? But so the current ratio is not greater than 2. It's less than 2. All right. Total debt less than 2 times the net current asset value. All right. So this is another debt related metric here. Once again, this is going to be skewed because of the fact that we have those leases. All right. So it's a total debt less than 2 times. All right. So we are at, according to this, 0.78. All right. So pretty good. But you'd have to also kind of back out those leases if you were interested in looking at their total debt in a more accurate fashion.
Got it.
So I think that is cool. All right, but they do get that point. Earnings growth over the prior 10 years, at least a 7% CAGR.
I'm going to say no.
Yeah. Not so much.
No.
Right? Yeah, it's a little inconsistent, but you're not looking at retail growing at a 7% CAGR, right?
No.
They have a lot of fluctuation in their year-over-year growth rates here, and many quarters that are negative. So I certainly cannot give them a thumbs up on a 7% CAGR over the last decade, because that is not even like in the realm of what they pulled off. In fact, if you look at their EPS, they're actually like half what they were 10 years ago. It was like $4 a share. Now it's like $2 a share. And that's even the last trailing 12 months, never mind the future, in which we're looking at a little bit lower earnings. Yeah.
No bueno.
And then in terms of stability, I did give them that point, though, because they have only had a couple of declines of, significantly 5% over the last, 10 years or so. So there's only 2 times where they really went consistently negative here, right?
Okay. And one of those was COVID. That was expected.
Yeah.
Because everyone went.
Absolutely. So that's why I was like, I'll lean towards giving it to them. So these are some of my thoughts regarding this, right? All right, maybe an asset play. Now, I am not a commercial real estate guy, but I did see some analysis out there of KSS looking at it from a commercial real estate liquidation standpoint, right? Well, what would private equity buyer want this company at? The market cap's only 1.5 billion, so this is definitely in the territory where you could do like a leveraged buyout sort of operation. If you're looking at the market cap and then the debt minus the leases, you're looking at only about $3 billion in enterprise value here, right? It's not a big number. And basically their real estate footprint is pretty good. I've seen valuations out there that are looking at, they are sitting on $8 billion in real estate, despite having only a $3 billion enterprise value. So yeah, that's there.
That's pretty good.
But the problem with that is, as an individual buyer, is you're counting on someone else unlocking that for you. You're counting on a CEO that's going to do a leveraged buyout. You're counting on a hedge fund that's interested in it from that standpoint. You're counting on an acquisition by a larger company. There are ways that value could be unlocked, but they're not things that are actionable on your individual basis. You're just kind of hoping that they happen, right? So, one of them, at least the CEO, does have a track record of doing this leveraged buyout to private equity. I think I want to say, was it Michael's? I think it was Michael's stores chain where he actually was involved in that, and they, kind of carried out a leveraged buyout. So it is something he has done in the past, right? And he just started this month. So who knows where his plan is at this point. We'll get a little bit more insight as they report earnings, and then you hear him on the conference call and find out what his plans are for KSS long term. So most of the debt, like I've already mentioned, is long-term leases, not really actual debt. These are really future expenses that get marked on the balance sheet as debt, which is unfortunate because it'll be offset by future cash flows too. So it's annoying in that you got to carry the lease obligation, but you don't get to carry the future revenue, obviously, because that's really unpredictable. So it's a little one-sided, which is why I understand exclude it. All right. So general summary here: long-term turnaround play with cheap underlying assets. Okay, there's definitely some potential, right? And this is the thing I wanted to mention here as far as the dividend not being safe. This is scary. This is from the last quarterly filing we have for them.
Yeah.
They had $52 million in operating cash flow in the first 6 months of the year. They paid $166 million in dividends, though. And then they also had $267 million in purchase of property, plant, and equipment. Right? So that $52 million is not even free cash flow. Their free cash flow was negative. Right, you're talking about negative $300+ million, and then they paid $160 million. You know how they did that? They borrowed.
Yeah.
That's
not good. So, ideally, for this to be a decent play, something has to change. I do think, for the record, 20 years from now, I don't think Kohl's is going to be here. If I'm being honest with you, I don't. There's too many of these that are dying. The Kohl's by me, it has an Amazon return drop off. That's the only time I've ever went inside. And I will tell you, that drop off counter, very busy. The rest of the department store, there's not a soul in sight. There's
Well, that's part of their strategy. Did you know that they move the Amazon drop-off counter around the store in order to like make you have to go play hide and seek to get it, and it's like
yeah.
never in the front of the store. It's like a
Oh no,
brilliant
it
idea.
was in the back. It didn't work.
Yeah.
Not one person bought something, and I've done it like 6 times. But that's a limited thing. Now, while you were doing this, I had an idea, and I just
What's
want to
that?
throw something at you. Okay.
What's that?
So here's their chart going back 20 years. Let
Uh-huh.
me move our faces here. We're approaching the lowest point, which was a COVID low
Hmm.
of about 11, 1050 ish. Okay. What if I told you that Macy's short interest 6%, Dillard's 11.5%, Nordstrom 10%, Target 2%, Kohl's 42%.
Wow.
42. That is a heck of a short interest.
It is. I think the shorts are right for now.
I would
Okay.
agree, but no, sorry, that's short float. I should clarify, not short
Yeah.
interest. Um,
So
I may look at this for a trade. If this hits
yeah.
around the $11 mark, typically, I'm not saying it's justified, but typically you'll have a decent bounce at a strong support, whether it's justified or not. Sometimes it shoots right through it, and that does not happen. You just lose your
Yeah.
money. But when you have a bounce on a company that has 42% short float, usually the bounce is a little
Violent.
bit exaggerated.
Yeah.
So for an investment, I am not interested in this. For a
Okay.
trade, if it hits that level, I might buy some 6 month calls or something like that.
Interesting. All right. So for me, the way I see this playing out is I think the new management's going to announce a pretty drastic dividend cut, and I think you're going to lose a lot of dividend investors that are in the company at that point. We've seen it happen with Warner Brothers. We saw it happen with I'm sorry, AT&T. We saw it happen with Intel, and it's pretty brutal for the stock when that happens. Um, I would be interested in purchasing it after that, but then I would limit my position sizing. All right, Benjamin Graham, who kind of did this style of investing, he always wanted 25% bonds and then 75% of portfolio in equities, and of those 75% in equities, it was amongst 20 companies. So he will never have a position more concentrated than like less than 5% of his portfolio in one particular name. All
Yeah.
right. So from that standpoint, yeah, I could see having a small position, but not until after they cut the dividend and after we've heard from the new CEO as far as his plans for Kohl's.
Yeah, and I
So I would
agree.
definitely go
We have to
after
cut the
the dividend.
dividend, which cutting the dividend could drop you. You need like another 20% drop to hit this level. So that could be it. And then I could see myself buying some calls.
All right,
A
fair
trade,
enough.
not an investment.
All right. Well, Andy, let us know what you think about it in the comments down below. We'd love to hear your thoughts, and as well as everyone else out there in the Kohl stock or Michael Burry and value investing, Warren Buffett, Benjamin Graham community. We'd love to hear your thoughts. See you down there.